All right, welcome to week 5. We are over halfway through the semester, and with this class, definitely more than halfway through. We're going to have this week's lecture over kind of continuing a little bit with federal income tax and within going to state and county taxes as well. Looking at a little bit of fair tax today. We're going to just kind of introduce that topic just to show what it is, what it means. And then next week, we're going to have our Futa and Suta week where we look at unemployment. And that's going to be our last real lecture. So we are on definitely the backside. If you haven't started your payroll project, make sure I would definitely get started with that this week. Once you get these assignments done, make sure these are done first, and then go in and start and try to get at least the first month of the payroll project done. You can go in, I'll have a short 15-minute or so kind of introduction, if that even, where I'll kind of introduce it, at least watch through that to kind of get you ready to go for the payroll project. All right, at this point, as we did last week, I wanted to start out with a review to make sure you have the material down from last week pretty well. So if you haven't already, I want you to go through these review questions and answer them as best you can. Go back and look some of them up. That's going to really help you to get the material down. And then we're going to go through the answers. So go ahead and pause now. All right, let's go through the answers here for the review of last week, the module 4. So the first thing here, list 3 fringe benefits. There are more than 3, but if you would have put any one of these down, these would have been 3 fringe benefits that I gave as examples. There are probably others, but these are the ones that I had in the notes. Just quickly, remember the de minimis means it's too small for it to be kept track of, like copies of a copy machine, cell phone, personal use on a cell phone. The no additional cost services, remember that was if you are an employee of, say, Southwest Airlines and you take a free flight with them to a vacation. That's a nice perk, and it's not taxable. So that's nice. And that's for you and a spouse and your dependent kids. Qualified employee discounts, not taxable. So whatever you save there, they're not going to put that onto your W-2 as taxable income. Reduced or free tuition and educational assistance. These two kind of go together. It just depends on where you work. If you work at the actual college or university, you could get free tuition, and that could be any dollar amount. Or your employer, if you're not at a college or university, your employer could help pay for that. And then that's not taxable to you either, even though you're getting essentially kind of free money. It's not paid to you, it's paid directly to the university, but still you're getting a nice benefit. And then the medical plans, FH having money put into that by the employer, HSA having money potentially put into that as well. Putting money aside into your 401k would also be an option there. All right, number 2, what payroll deduction is taken out for federal income tax, but not FICA? So this is something that you take out of your paycheck to pay into, but it doesn't get, for FICA purposes, it's still counted. Remember, that is your retirement. Any type of retirement withholdings, they take out for federal taxes, but not for FICA. List 3 specific employer payments that are not taxed. You could have, there's more than 4, but I just picked 4 here. Or in this case, list 3. Anytime the employer pays you back or pays you ahead of time for future expenses that are going to arise, that you don't have to be taxed on that. If they pay for group life insurance premiums, great, nothing that you have to worry about there. If they pay for your parking, or they pay for dependent care expenses, or you get dependent care expenses, actually they provide the child care, and it's up to $5,000, not taxable to you. Who pays federal income taxes? Remember, that is just the employee, not the employer. Which form is filed quarterly for the FICA and federal income tax? That would be Form 941. When are the FICA and federal income taxes deposits made? Remember, that's either going to be monthly or it's going to be biweekly. Are wages received from workman's comp taxed? The answer there, it would be no. are the wages from unemployment taxed? And the answer there is yes. So 7 no, 8 yes. Number 9, which payroll deduction has a use it or lose it rule? That would be your FSA or your flexible spending account, where you put money into to pay for medical costs like a doctor bill or prescriptions. But if you don't use it, you typically will lose it. Number 10, what are the 2 typical amounts allowed to be deducted for an IRA contribution? That would be $6,000 for those under 50, $7,000 for those 50 and older. What is the IRS phase out range for someone with no company 401k plan? And the answer is there is no phase out. Anybody can put into an IRA, no matter how much you make. What form is used to determine how much federal income tax should be deducted each pay period? Well, that's where the employee is going to fill out that form W-4. And then the employer would use that publication 15-T to actually go in and calculate how much taxes are taken out. Writing exempt below line 4 on the form mentioned above, which is the W-4, will do what? Basically, that means that the employer will not take out any federal income taxes out of your pay because you do not think that you will meet the requirements to need to pay. You'll be under the filing threshold. So therefore, nothing will be taken out. And there may not, except for state taxes, you may not even need to file. It's always best to go ahead and file anyway. Maybe you'll get other things like earned income credit, perhaps, or child tax credit, the additional child tax credit. What is meant by the marginal tax rate? Well, that's how much are you going to be taxed if for every dollar you make over what you currently do. You're going to be taxed at that rate until you hit the next threshold, then you're going to be taxed even higher for those additional dollars. Not every dollar is taxed at that. The dollars before that are taxed at a lower rate. And that's what, when you get into an average rate. The average rate is, well, what are you paying overall on all of the dollars, not just the next dollar. And that's what the difference there between 15 and 16. Oh, I skipped one here. How many marginal tax rates are there for federal taxes? There are 7. And basically what I would want you to remember is the bottom 2, those are pretty common ones, the 10 and 12%. And then the top one at 37% would be the ones that kind of stick out. The last one that I have you do for a review, and let's talk through this, and then I want you to take a second to go through it. And actually you can pull up your payroll template, and I think it'll be, hopefully you will get it all correct. So I give you this information. The biggest thing here that you're going to make sure you know how to do is figure out how much federal income taxes to withhold. I also want you to go ahead and do the county and Indiana rate for this one. So use your payroll template to determine his net pay, and then go ahead and do the journal entries. All right, so we're going to talk through, once you give it a shot, we're going to talk through this one and make sure you've got the federal withholdings correctly. So go ahead and pause now. Okay, let's look at the answers here. Tyler's married, wife earns $42,000 a year. So that's going to be important once we determine what we make per year, or what Tyler makes this year. Tyler claims $2,000, or Tyler is married, wife earns and claims $2,000. I should put on his, there we go, on his W-2 Part 3. Tyler is paid semi-monthly, earns $6,200 per check. That's, he makes a lot of money. This is the last pay of the year. So if he's paid semi-monthly, that means that there are semi-monthly, that would be 24 pays. So they've already had 23 pays. That would be our prior pay. Here's how much he puts away into the different options that he has available, how much he puts away into the United Way charity. And then his employer pays so much into these different items as well. All right, so let's go through here. He has $6,200 of gross pay. Now this one I'd set up in a semester or two prior. So on yours, you would actually fill in here this blank for how many prior pays. You would put 23. What I did is I actually put it into my formula, and it's not as actually as efficient as the way that I showed you how to do it in your template, because I had to put in 23 here and I put in 23 here, and I had to put in 23 in different places, and you only want to put it in as few places as possible. So if I ever had to go back and change this, then I would have to change it in 3 places, whereas in your template, you only have to change it once if you put it down here where we had set up for our template. All right, so the next thing we want to do is to determine what our Fed wages are and Medicare wages. We need to come over here and insert in these items that you should have in yellow. These are your yellow items on yours. Actually, these, and then this one, we could have called it, we could have named it, in this case, it would have been fine to call it United Way, because that's what it is. So these are the items in yellow that you physically would fill in, the 350, and then these are going to, you should have these filled out based on your formula to get what your current federal taxable wages are. Medicare, it's going to be slightly higher because they don't take out the 401k. And then this one we're going to have to actually calculate because we are really close to the cap. The cap is 137.7. We are getting very close. So we come down here and I did step 1 and step 2. So step 1 plus the current wages, 58.50, puts us over the cap. And we need to do the Medicare wages here, not gross, not federal, but the actual FICA part. Once we're over the cap, we then put what is the cap and subtract out the 134,550. And that's how I got this number here. All right, so, and this is the amount now we're going to look up to do the calculating to figure out how much taxes to take out for federal income tax. And that's actually what's going to be coming up next. Social Security tax, that should be calculated for you if you set up your template good, and most of you have. Now let's look at how we got the federal withholdings. That's going to be the part that for most, if you missed anything, would have been here. So let's pull up first off the W-4. It tells us in the problem the couple things that we need to know. All right, one is that he's married, so that's going to, depending on what we're going to look at, we're going to need to know that. We're going to need to know that his wife earns quite a bit different than him, so we're going to need to go to the bottom of the W-4 when it gets time to do that and look at the schedule. And we're claiming $2,000 on his W-4 Part 3. All right, so we would not be checking this box because this one is if your 2 jobs, you and your spouse or both of your own jobs are about the same. Nope, that's not the case, so we're not going to do that. We're not going to check that box. We're going to have the 2,000 here. We're going to need to remember to do that. So the first thing we do before we even come down here and look at this chart at the bottom, we're going to first calculate his actual federal income tax, just bare bones before we do any adjustments, any changes to it. This individual is paid semi-monthly, so we need to go down to semi-monthly and then to the married section. All right, so semi-monthly, box 2 is not checked, so we're looking here. We need to go back and look at his federal taxable wages. It's $5,500. So that puts us right here in row 4. So we're going to take 5,500 minus the 4,377, and that's what I did here. I took the 5,500 minus the 4,377, and then I multiplied that by his marginal tax rate, 22%. That left me with 247.06. And then all I did is take the 247, add in the 384.82, and bare bones, that's what he's going to be paying in for federal income tax before any other adjustments. Now we come down and do the step 3. We need to take what he makes, or how much he put in step 3, 2,000. Divide that equally over 24 pays. So that's telling us that we need to subtract $83 from our base number here. And that's what I did. I took the 631 minus the $83. And then finally, we need to see what our total wages are, because when we're going to come over here to the part 4, we look at our wages and then our spouse's wages. It says do the higher paying job, look at their number over here, then the lower paying job off along the top part. And this is for married filing joint. Okay, so our wages for Tyler, if we look at, we need to add 5,500. So 126 plus 5,500 would give us his full yearly federal wages. So that comes out to be just over 130,000. So we're going to come over here to our charts and find where 130 would fall, and it would fall in this line here. The spouse makes, I believe it said 42,000. So we're going to come over to this number, and we're going to take this number and divide it by our number of pays. So 8220. Take 8220, divide it by 24 pays. This is how much I need to add back in to my new amount. So that's all I'm going to do is take the 584, add back in the 342. That is how much needs to be taken out of the individual's check. So 891.05. All right, it tells us we're in the state of Indiana, so that is 0.0323%. It told us the county was 2%. I filled that in down here. And that brings me to my net pay. Notice there's nothing over here for the FUTA and SUTA, and that's simply because we're way over the cap. Didn't even need to know that information for this one. All right, for the journal entries. Got our wage expense, how much they made total, and then subtract out our Social Security, everything that we have. The only thing that I don't have on here, and I don't think it's going to match. So if I was doing my check figure, which I need to be doing, so somehow I've put it in here. I don't even know how I did it. Let's check. It says 3866. And yep, 3866. But if I would do my check, it's not going to work. I'm almost sure of it. Because if you note here, I don't have my other. If I did this, if I did my check figure and I took my this and then subtracted all of these, it wouldn't match. I know it's not because I don't have my last category in here. So let's put that in here. We'll just call it what it is, the United Way withholdings. And copy that right on over. So hopefully yours would already be set up like that. For whatever reason, mine was missing it. Now, if I update my check, bring this box down, it should match. It still doesn't, and that's because I'm a little leery here. I don't think these two should be the same. So somehow I've got off. Yep, I got two U5s here. So let's put my flexible spending where it needs to go. My flexible spending was actually, oh, for some reason I don't even have a total there. And I don't even know why. So this, my review sheet was all kind of messed up. All right, let's go put the total in here. We didn't have to total anything, so I'll just put that 150. Let's come back over here. There we go. Now, that's why you do a check, because things are going to happen like that. And you can easily catch it, correct it right away. Payroll tax expense, the only two we have is Social Security and Medicare. If we had more pays after this, we wouldn't have any Social Security. We'd only have the Medicare payable left. So our payroll tax expense would have gone down. I didn't have us do the last ones, but we could have gone ahead and done the journal entries for that the employer pays the various items here. I'll go ahead and put them in, might as well. His employer pays $300 into his 401k. All right, so let's put that in. We've got a 401k expense. And we've got the 401k payable that we're going to add into. So that's what that would look like. $50 into his life insurance policy and $800 for his medical insurance. All right, so we've got to do them all. You can't just leave one out. So we've got his life insurance expense was $50, and we would have a life insurance payable. We don't have one of these set up yet, but we would need to set one up because we need to pay the life insurance company, even though the employee doesn't ever pay into that. And finally, we've got his medical premiums expense, and that one was a pretty high number, $800. And then his medical premium payable that we would tack on. So the employee already puts money away into the medical premium payable, or I'll keep going up here, that's Medicare. Medical insurance payable, $200. We have the same thing, it'd be the same account. I just called it, I don't know why I did. We would call it the same account here, medical insurance premiums, whatever we want to call it, $800. All right, that wraps up the review here. We are ready to jump into the new stuff. And the first thing we're going to look at is the W-2. W-2, everybody's familiar with the W-2, but we need to, let's make sure we have all of the aspects down on what's required and what's not to fill in on a W-2. So I would, and I'm going to have this going as we go through, but you may want to pull this up. I have it in the learning activities. I have all these forms that we're going to go through in the learning activities. You may just want to pause and bring them all up all at once, just like how I have them all up here as well. First thing is, when do you need to make the W-2s available? What do you have to do with that? So you have to make them available by January 31st, unless you get a special extension from the IRS. If for whatever reason something's happened and you need a little more time, you're going to need to let your employees probably know that too, because they're going to be expecting it. Be postmarked by the 31st of January. So yeah, it may get to them a couple days later, but it needs to be sent out postmarked by then, normal due date. You're going to have to send the W-2 to anybody that had Social Security taxes taken out, that had any kind of federal income taxes taken out, or would have if they would have not been exempt, meaning they wrote exempt down there, you know, at the bottom of the page, at the bottom of the W-4. You've got to make a reasonable effort to deliver this W-2 to the employees, even those that may have moved on. If it comes back to you undelivered, you don't open it, keep it postmarked that shows that you did send it out, you gave it your best effort, and then keep it for 4 years. And you can see some of the other rules and regulations here if you would go into this link. All right, so let's look at, get this taken care of. All right, let's look at the W-2. Let's go through some of the aspects. All right, so the important parts, especially when you're doing a tax return, got to have the employee identification number. The IRS is going to use that to, if this is entered in wrong, then it's going to be, the returns very well could get rejected. Of course, the employee Social Security number needs to be correct too, because that's, the IRS is going to use that to compare, to say, this is what you put into the tax return. This is what the actual W-2 says for this Social Security number. Make sure they match. The IRS will do that. Then box one, this is your federal income taxes that are, your federal income taxable wages, not your gross wages. So nowhere on here does it ever show what you made in gross. unless you don't ever have anything taken out of your paycheck. Then they're all going to be your gross number. So just because box 1 may say 50,000, you may have actually made 54,000, but you just had money taken out for medical premiums, for FSA, for different items that are not taxable. And so that's why this number may not ever be quite as high as what you actually make. Box 2, this is the amount that you can actually get back on your tax return. When you file your 1040, this is the amount that will potentially be refundable if you overpaid. So box 2, that's one of the most important numbers on the W-2. Box 3 and box 5 will be the same as long as you don't hit the Social Security cap. Once you hit the Social Security cap, then box 3 and 5 will be different, because box 3 will stop at the Social Security cap, which if it was for this year, for 2020, it would stop at $137,700. Medicare wages would keep right on going. So it's very possible, it's not likely because you'd have to be pretty high income, but it is possible to have boxes 1, 3, and 5 all be different amounts. And the reason that would happen is you have 401k being withheld. So box 1 would not include the 401k amount. Otherwise, it would be the same as box 5. But so box 1 could be a little bit less than box 5, because box 5 would include the 401k that was withheld. It would still include that as taxable. And then box 3 would stop at $137,700. So though it's not likely, because you're not going to have a lot of high income people, it is possible that all 3 could be different. It's very possible that box 1 would be different and then box 3 and 5 be the same. That's for those that have 401k but haven't hit the cap for Social Security. And then it's also quite possible that all boxes 1, 3, and 5 will all be the same. If you don't hit the Social Security cap and you don't have 401k or any type of retirement money withheld, boxes 1, 3, and 5 will be the same. So it could be any one of those options. Box 4 and box 6 shows just how much you have taken out, if it was properly withheld for Social Security and Medicare, how much taxes were taken out. This is going to show if you had, especially with a job with tips, that's what's going to go here in box 7. We're going to come down here to box 10, dependent care benefits. This is if you put money aside into a flexible spending account for dependent care, it's going to show up here because that's going to be an important amount for other places on your tax return. When you start talking about child and dependent care credit, that's going to come into play here. And did you spend it all, different things like that. So it is important that it goes on there. It's an important number. Box 12, you could have lots of different items here. The first column here is alphanumeric, where it's going to be a letter, and it even goes, there's so many codes that it even goes double letters. It goes like AA, BB, CC all the way, and I don't remember how far it goes, but it goes a little bit deep into the double letters. And then out to the side, it's going to give the actual amount for whatever that subcategory would be. The most common ones are going to be codes D and or E. That's how much you have put aside into a retirement plan. It's going to say D or E, depending on the type of retirement plan, and then the amount. The other very common code that you're going to see is DD, and that is how much the employer put into your how much the employer paid into a medical insurance premium plan for you. Box 3 or box 13, this is going to be checked. Remember, especially for the IRA, this is going to be important here. If you have access and the employer has put money into a retirement plan for you on your behalf, if you put money in, it's going to show up over here. If you didn't put money in, but you still have it available and the employer's put some money in, this will be checked. And then therefore you have some of those limits. Remember we talked about with the IRA last week, that if you have an option of a retirement plan, then you could be limited on how much you can put into an IRA at that point. And then if you meet one of those statutory categories, this would be checked. Box 14 is simply for other information. Nothing in box 14 would go on your tax return directly. It may show how much you paid into medical insurance premiums, just as extra information. It could show you other things. A lot of times it's just left blank. And then at the bottom, line 15, through 20. The main ones you're going to look at here are lines 16 through 19. And this is a lot of, for Indiana, boxes 16 and 18 are pretty much going to equal whatever box 1 is. They base on your federal wages. And then boxes 17 and 19 are the amount of taxes you actually paid into the state and local. And these would be the amounts that you could potentially get refunded on your state return. Just like on box 2 for the federal return. For the state return, it's boxes 17 and 19. So those are important numbers for the state. All right, so that takes us, I went through, okay, we're down here to the W-2 example starting on page 4. And I ask you, so I want you to tell me, with this situation here, where I want you to tell me just simply what would go in boxes 1, 3, and 5 when a person has $145,000 in gross pay, and then you know that they have $5,000 put aside into a 401k and $4,000 into a medical premium. So go ahead and fill out boxes and just put what boxes 1, 3, and 5 would be. Go ahead and pause now. All right, let's see how you did. This is a situation where all 3 boxes would be different. So box 1, you're going to take the 145 and you can actually subtract out both of these. So we would take 145 minus 9,000, and that's where we get 136,000. Box 3, we cannot take out the 401k. That's still taxable. So we take the 145 minus the 4,000 medical premium. Leaves us 141,000, but we can't go over the cap. So the cap is 137.7. So that's all the more I can put. Box 5, there is no cap, so we put the full 141,000. So an example when all 3 boxes would be different. All right, on this one, I actually want you to fill in boxes 1 through 12. All 12 boxes. Well, you're not going to fill in a couple of them in there just because they're not used, but especially boxes 1, 2, 3, 4, 5, 6, and box 10 and box 12. And the hardest one is going to be box 2 because you're going to need to actually do the calculation. All right, go ahead and pause now. All right, so looking at lecture example number 2, box 1, we're going to start off with annual salary of $55,200. So I'm going to pull up a calculator and work through this just to double check the answers that I have because it could have an error. Let's check them. 55,200. Medical premiums, yep, we take that out. The employer paid, doesn't matter right now. That'll come in later. 4,000 into the 401k, yep, can take that right out of the federal income taxes. FSA for dependent care, yep, can take that out. Medical FSA, yep, can take that out. Child support, nope, can't take that out. So we should have box 1 of 43,000. Okay, there's box 1. Now, for box 2, the hardest one to calculate, what we need to do, it says, all right, we need to go to our publication 15T. It says box step 2 is checked on this one. So Joe and the spouse make about the same amount of money. So we're going to do the right side of the column this time, the one we don't use all that often. And at least in our examples, we haven't. And then we're going to need to remember that he does have 2,000 there for step 3. All right, so let's look at, it says he is paid semi-monthly. So let's figure up what he actually makes then semi-monthly. If he makes 55,200 and we divide that equally among 24 pays, that's $2,300 every paycheck, gross pay. All right, so that's going to be our starting point, 2,300 paid semi-monthly. All right, let's look at it. I'm already on the semi-monthly. This time we're going to be looking over here. Individual is married. So 2,300 puts us just barely into this fourth row. So we're going to take 2,300 minus 129. It's been a while since I've done this, so I don't even remember if I did that. Oh, sorry, I forgot to do something. I forgot to, the 2,300, that's important. And I'm glad, I'm glad I saw this. I don't want to take, what I did is I just simply took this amount and divided it by the 24 pays. I don't want to do that actually, because that's the gross. Then what I would have to do is take this amount and divide it by 24, this amount divided by 24. Well, a much easier way to do that is just say, okay, well, what is your federal tax amount for the whole year? Divide that by 24. So let's do that here. Let's take 43,000, divide this by 24 pays, $17.91.67. So actually that puts me $17.91. That puts me here. I'm going to take $17.91 minus $9.28. $17 minus $9.28. I got $863.67, and then multiply that by 12%. Take the 103 that I just got, add in $41.10. So my starting point here, how much taxes I need to take out, 144.74, but I'm not quite done because I need to then take the 2,000 from step 3, divide that equally among 24 pays, and then take that $83, subtract it from the 144. That is actually how much is taken out per paycheck, $61.41. Now that I don't want to put that, that's per paycheck. I don't want to put that in box 2. That's way too low. I got to take the 61.41 and then multiply that by 24 pays. So box 2 would show 14.74. They always round up, or they always round to the nearest dollar for tax purposes. Or if they don't, the tax program does it for you. So 14.74 would have been the final amount there. If they put the actual cents in, that's fine. It's just usually when you do it on a tax program, it will round to the nearest dollar. So that's what box 2 would be. Now box 3, get rid of this. Box 3, we would take the easiest way to do box 3 is just start with your federal 43,000 and then simply add back the amount that went into the 401k because you can't subtract it. So 43,000 plus the 4,000, 47. So 47 would be box 3, nowhere near the cap. Take that times 0.062. That should be box 4, the 2914. Box 5, since we didn't hit the cap, box 5 is going to be the same as box 3. Box 6, just take the 47,000 times 0.0145. Of course, you would need to verify. I'm putting these in because we can't see all 24 pays. The employer would verify that, yeah, this much was really taken out of his paycheck, $681.50. Now, the amount here that is for the dependent care, that would go into box 10 of the W-2. So box 10 would say 1,500. And then the last ones here, how much went into his 401k? 4,000, that would be code D. Code E is if you have a 403B, which is the exact same thing as a 401k. It's just for not-for-profit or government entities, employees. And then code DD is how much did the employer pay into his medical insurance premiums? And the employer paid a total of $5,500, it told us. So that is how we would have filled out the W-2 for this employee. I got some extra examples of those in the practice, so take advantage of those. Make sure you have that down. All right, the W-3. What the W-3 is simply is a summation of all the W-2s that that company sent out. So if you have a whole bunch of employees, it could be some really big numbers in there. When you look at the W-3, it's going to mainly, we're going to check the box, what's called box B, and box B, we're going to check this form 941 that says that's what kind of an employer we are. We do federal income tax and the Fica taxes. Box C, basically you'll put a number there. How many employees are you sending out W-2s to? And then boxes 1 through 6 are going to mirror the boxes 1 through 6 of the individual employees. It's just you're going to add them all together. So box 1 would be all of your employees' amounts into one big number. Same for all the other boxes. Note here, you have an extra month to get this into the IRS, this form W-3. So that's what the employer sends in as a summary of all their W-2s. All right, some other important informational returns that go out to different people for making different amounts of money. The 1099 miscellaneous compared to a brand new form. Notice it's just coming out in 2020 for tax year 2020. So this will be the first year that it's actually sent out, or that it should be sent out if it is, if the people know about the change. It's called the 1099 NEC. This is what's going to go to any independent contractors. Before, independent contractors received a 1099 miscellaneous, and sometimes the amounts were put in the wrong box. So now they have, independent contractors have their own form, and they probably should, because that's probably by far the most common item you're going to find in the 1099 miscellaneous. You're going to find that most of those time it's sent out is for independent contractors. Now, it's not the only time, of course, but I would say it may be the most common. So let's take just a quick peek at these two forms here and see what they look like. The 1099 NEC, as you can see here, it's really simple right now. All it shows here is how much compensation did that non-employee get. So any independent contractor, you're just going to put it here as the company who hired them. And then if you happen to take taxes out, put that here. It's most of the time going to be 0 though. And then if you happen to take state income taxes out as well, it would most of the time though will be 0. And you'll just have an amount here that the IRS is going to verify, hey, did this employee actually record and put on their tax return that they have an extra $2,500 that they earned as a non-employee? Did they put that as an independent contractor? Now compare that to the 1099 miscellaneous. In prior, if you would look at a 2019 and before miscellaneous form, box 7 is the one that's going to be different. Box 7, that used to say non-employee income. So now it's different. So the main parts on this one are going to be if you have any type of other income. And this is where a lot of people mistakenly, they put the independent contractor here and they really shouldn't have. It should have been down here in box 7 before. The main ones now are going to be anybody receiving rents and royalties are going to have 1099 miscellaneous. Not much more to talk about here. All right, so I give you a little bit more information here about the 1099, that new one NEC, the old 1099 miscellaneous. The only time that it's required to be sent is if the individual, the independent contractor, they paid over $600 to that private company. And note, this is only for companies. Only companies have to send these out. So just because you hire somebody, say electrician, to come rewire your whole house and it costs, who knows what it costs, a lot of money, say $5,000, most individuals wouldn't know to send that out, and they're not expected to do it. So you can see that it's very possible that nothing is ever reported to the IRS for that individual who just works for private homes, because they're not, private home owners aren't going to know to fill out this form and aren't expected to. Therefore, that the electrician is going to have a lot of income that's never reported. So it's going to be up to them, and the IRS is going to look at that and say, and that's where they may ever have an audit and say, hey, let me see your bank records. Do you have a lot of money coming in that's not being reported? And then if it's not reported, can you prove that it's not taxable? That's where a lot of people get in trouble. And then also, of course, if you do a small job, you get paid $350, and that's the only thing you do. Even if you worked for a company, they don't have to file a 1099 miscellaneous for you. Some other forms here, a few others. The W-2G, if you win money with the lottery or at a casino, you're going to get a W-2G. I know these every once in a while, some of our VITA clients will come in with one of these from a nice size lottery winning, or they went to the local casino. 1099 dividend or a 1099 interest. This is just showing how much you've earned through dividends or interest. That's all it is. It's pretty there are some different categories within this. It's not quite as simple as that, because there are non-taxable interest and there are just different ways of getting interest, but that's all they report on that form. There's a 1099 div and there's a 1099 INT, two separate forms. 1099R, this is going to show how much basically this goes to individuals that are retired who take money out of the retirement plan. But you'll also get one of these if you roll a plan over, if you switch jobs and you do a rollover, but you do what's called an indirect rollover, which is not advisable. I wouldn't do it. It's where you take the money from your former retirement company that you used to be with your old employer. You take the money and then you take it to the next company. It's going to show up as a withdrawal for that full amount. And unless you can show that you moved it over into a new company, you're going to be taxed and penalized on that, especially if you aren't of retirement age. We talked a little bit more about that in income tax class. And then anytime an employer fills out one of these informational forms, they have to file what's known as a Form 1096 for each special type. So they could have to fill out 4 or 5 different 1096s. And it's going to state, okay, this Form 1096, which category are you working with? Are you working on all your 1099 miscellaneous added up? All right, then you're going to fill out the boxes for all the 1099 miscellaneous. Then you're going to do another 1096 for all the 1099 divs that you did. All right, so for Indiana, we've already talked about this back in week 1, but now we're kind of making it official. Something you should memorize for this class. When you pay your when you file your Indiana income taxes, you're taxed at 3.23%. And so just to make it so it's pretty close, it's not going to be exact necessarily. If you would actually go in and look at your payroll, what do I want to say here? Your payroll stub. It's going to be pretty close, but not necessarily exactly 3.23%, depending on if you have how many withholdings you had on your prior W-4s. That could be a little bit different, but it's going to be pretty close to 3.23%. So that's why I have us do that for this class. Now, one of the big things about state taxes. State taxes are taxed at where you live. Well, that's not, you think, well, I should be taxed on where I live. And that's not necessarily the case. State taxes are taxed on where the services are done. And this really goes into those employees who travel around a lot and are in different locations for quite a bit of time. The ones that hit this the hardest, and we're going to see this in a little bit, is professional athletes. Professional athletes that go around and play in 15 different states could potentially file 15 different state income tax returns, just because you owe taxes in the state that you earn the money. And if you played an NBA basketball game in the state of California, you made part of your salary, part of your 81 games that you play, part of it is earned in California, because that's where you were when you worked as an NBA player. So that's where it starts to get, can be really kind of hairy, kind of tough to do. So you pay taxes on where you work for state purposes. Now note the counties are different. Counties, when you're in Indiana, They tax you on where you live. So just because I'm headquartered out of the Muncie campus in Delaware County, I'm actually taxed on the county next to us, or next to Muncie. I'm taxed in Madison County because I live in Madison County. Even though I work in Delaware, taxes are based on where you live for the county. Now, it's also good to note that there are 9 states that actually do not have a state income tax. And that is going to be your discussion board for this week, is looking at these 9 states. I want you to go through and figure out, because I give you the starting point. I say, okay, Indiana, they collect, and I break it down, this much of the taxes that go into the state of Indiana to pay for all the different things that Indiana pays for through the government. This percentage, and I break it down, I say this much comes out of the income tax budget. This much comes from the sales taxes that you pay. And then this and all the rest come from other sources. So if these states don't collect any income tax at all for state income tax, where do they make up the money? And that's what I want you to look up for your discussion board. And then I'll give you a hint that you actually get extra credit if you're one of the first 2 that go in and indicate which of these 9 states also doesn't have a sales tax. And so 2 of the states here don't have a sales tax or an income tax. That can be a big savings if you spend a lot of money. All right, so if you ever wanted to, if you're not sure what the Indiana income tax form looks like, you can click here. You probably see it once a year, so you're not real familiar with it. But if you're interested, you'll see down towards the bottom of page 1, where you actually calculate your Indiana income tax. It'll show you there that to multiply the number just above by 3.23%. You'll actually see it there on the IT 40. Now, I give us a scenario. What if somebody lives in Jeffersonville, Indiana, so that's way down at the bottom of the state, right along the Ohio River, but they commute over to Louisville, Kentucky. So it's, could be minutes. It's just across the river, perhaps on to where you live. So it's not very far. Do both states tax the individual? And the answer here would be no, not in this case. But then you might say, well, I thought you taxed on where you work. Most of the time, yes. But when states border each other or they're pretty close to bordering, a lot of times they'll have what's called a reciprocal agreement. And they'll say, all right, I'm not going to tax, Kentucky and Indiana get together and they say, okay, I'm not going to tax your people that live in Indiana if you don't tax the people that live in Kentucky. We'll just pretend that they work in our own state, and you'll lose some employees, but then you'll gain some of that worked for us, and vice versa. So we're going to pretty much equal out. And that's okay, and that works if both states have a similar size city right on the border. So Kentucky has Louisville right on the border, so they draw some people definitely in from Indiana, but Indiana has Evansville right on the border, and they're going to draw some people in from Kentucky. And so if both of those employees kind of just go back to their home state, neither state's going to lose much, if anything. Ohio and Indiana, of course, Ohio has Cincinnati. We don't really have anything on this side of Cincinnati, but Fort Wayne is close enough to the Ohio border that would count as probably drawing people in from Ohio that will work in Fort Wayne. Indiana and Michigan, there's no really, Indiana has South Bend. Michigan, I'm not as familiar with Michigan. I don't know if they have anything right there along the border, but still we have a reciprocal agreement with them. The one that we don't is Illinois. Back in 1998, it was rescinded, and it was mainly rescinded probably on the Illinois behalf because they didn't like it. Because lots of people from Indiana come in to work at Chicago, but not that many people from Illinois come over to Indiana and work in, say, anywhere in Lake County, like Gary or Hammond. So Illinois was losing out. They were losing out on all the Indiana employees who were coming over to work in Chicago. And they were losing all those employees' potential and then not gaining back some of the Illinois residents who were coming to Indiana. So that's why most likely that was rescinded if you would read between the lines. So here are the states that Indiana does have reciprocal agreements with, and you can see even a couple of them here, Pennsylvania, Wisconsin, aren't necessarily bordered, but they still have a reciprocal agreement. So that's good. It's good to have as many of those as possible. If no agreement between the states, then unfortunately the employees have to file a tax return in each state that they earned money. So you could have multiple ones. And that's what happens here. If you work, so say in Indiana, Pacers basketball player goes and obviously plays games in California, they would file what's called a non-resident state return. And then people do that for Indiana as well. If they don't live in Indiana, but they make money in Indiana, they're going to file a non-resident state. All right, so this is this is about the professional athlete. Notice here how they typically are done. You can read through this. I'm not going to read through it, but you can see they split the wages. If they play 81 games, that would be a somewhat easy way to split up your wages on where you're earning your pay. If you play 10 of those 81 games in California because they have lots of teams, then 10 out of whatever that percentage is would be on the California return. So there was this, this was reported in the LA Times. You can go and see the actual full article. I think this is pretty much the full article here. This individual, he played for a Texas team. And Texas is one of those states that doesn't have an income tax. But when it came time that he actually had to do state income taxes, you would think, oh, I don't have to file state income tax. Well, that's obviously, that would be wrong. He actually had to file dozens of state taxes, it says, for all the states that the baseball plays in. And read through this. So it says here, not every state uses the same calculation to determine what portion. So you just can't pick. The state will say, okay, athletes that work here, this is how much that we declare that you earned in our state. So Pennsylvania will do it differently, perhaps, than the article shows that Michigan does. So it's an interesting read. I just read through it. It's only a page or so. I think it's kind of neat. Indiana county taxes. You're going to see that Indiana county taxes differ between which counties you actually live in. And this is the last item that I'm going to be pulling up we've gone through all of these. Here's the last one. This one you actually have an attachment to as well. This is from the Indiana Department of Revenue. This is as of 2019, but I don't think any of them changed for 2020. So we can use this for 2020 as well. I'd have to go in and check to make sure, but I don't think any of them have changed. And you can see, you can find the county where you live and see how much taxes you pay compared to somebody else. You can see some of the lower rates here, the really low one here, Crawford County. It's only 10%, or not even 10%, but 1%. Compared to, say, Miami County is 2.54%. Morgan County down in South Central Indiana, 2.72%. So that's one of the higher ones. Pulaski County up north is one of the really highest ones, 3.38%. So if you're up there in Pulaski County, you must have some good stuff, some good roads. Whereas some of the other counties are more like 1.5%, 1.2%. The average, I would say the average is around 1.5 to 1.75%. So if you pay it in the twos, you're paying a little bit on the higher side. And so you'll scroll down and try to find your county where you live. You can see, oh, Spencer County, they must have not very good roads at all, 0.8%. So not that much goes into Spencer County. That's one of the lowest ones, just at a quick glance. LaPorte County, that's pretty low, 9.95%. Oh, Jefferson County, that's really low too. That's even lower. Sullivan County is pretty low. All right, so some of you are in some of those counties that I just mentioned. Gibson County is pretty low. So just a little bit over the Indiana county tax. In Indiana, you file this WH-1. I'm not going to take any time to go through these. These are just what you have to file to show that you're paying the correct amount of state taxes. All right. with that, we are going to close off this portion, and I'm going to have one more kind of abbreviated. This one won't take us too much amount of time, but we're going to go through the fair tax. So with that, I am going to close this out, and I'll see you in just a little bit for part 2.